There was a pharmaceutical company, Tylenol, Listerine, Band-Aid, Neutrogena, Aveeno, all familiar names. But what if these brands no longer belong to the same company? Before we dive into the story, a quick note. The analytical methods used in this video to break down the asset's fundamentals and risk signals can be found in the books tagged in the Product View button on the bottom left of the screen. Some of those books are currently on discount, so make sure to check them out if you're interested. This story begins in New Brunswick, New Jersey, where global pharmaceutical giant Johnson & Johnson made a surprising announcement in late 2021. The company decided to spin off its consumer health division, which included some of the world's most recognizable brands, into a separate company. That decision was formalized the following year, and in May 2023, the newly formed consumer health company went public on the New York Stock Exchange under the name Kenvue. The IPO price was $22. While the name was unfamiliar, the brands were anything but. Naturally, investor attention followed. Kenvue maintained stable performance after the spin-off. Its three business segments, self-care, skin health and beauty, and essential health, generated steady revenue, reaching approximately $15.5 billion in 2024. The company's greatest assets were its brand recognition, market dominance, and legacy consumer trust carried over from Johnson & Johnson. But Johnson & Johnson did something unusual. Unlike the common practice of retaining a stake in a spin-off company for a certain period, they sold off their remaining shares in Kenvue by May 2024. A complete exit and a quick one. This kind of rapid detachment is rare in traditional spin-off scenarios. At that point, investors began to ask the obvious question: why divest from a company with strong sales and brand loyalty so quickly? But the real mystery began after that. In July 2025, Kenvue announced the resignation of its CEO, Thibaut Mongon. On the same day, it appointed board member Kirk Perry as interim CEO and declared that it was initiating a full strategic review. Here, two unusual developments occurred simultaneously. First, the CEO transition. For large publicly traded companies, CEO successions are typically well prepared with an internal successor or a clearly outlined timeline. But Kenvue made no such announcements. It abruptly appointed an interim CEO and has remained in that interim state since. This is highly unusual. Second, the strategic review itself. Companies usually enter a strategic review when facing deteriorating profits, declining growth, or external pressures. Yet at the time, Kenvue's financial performance was stable. Sales were steady, dividends were gradually increasing, and the brand's market positions were intact.